Welcome to today's Explainer. In the global financial markets, billions of dollars change hands literally every single day. But here's the thing. Those massive capital flows, they aren't just random. They are actually directed by these invisible architects operating entirely behind the scenes, research analysts. Think of them as the ultimate selectors of the market. A single rock-solid recommendation from an elite analyst can swing a stock price by double digits in minutes. They make or break fortunes, and they steer the direction of entire industries. So today, we're cutting straight to the core of this high-stakes profession, and we're going to examine the precise frameworks they use to decode the market and uncover true value. So here is our roadmap for today. First, we'll cover the research analyst role. Then, we'll look at the types of research analysts. After that, we'll dive into economy, industry, and company analysis. Fourth, we'll go over the rules of engagement and ethics. And finally, the essential qualities of analysts. All right, let's jump right into Section 1, the research analyst role and its core functions. To really get a grip on this, we need to start with the official definition. According to the Securities and Exchange Board of India, or SEBI, a research analyst is formally defined as a person who, for consideration, is engaged in the business of providing research services. And yes, this includes part-time analysts too. Now, the absolute key phrase to focus on here is for consideration. That legally and professionally separates a formal analyst from, say, a regular retail investor or some commentator just sharing casual stock opinions online. Because analysts are actually paid for their objective, rigorous research, they operate under super strict regulatory scrutiny. They are literally compensated to remove emotion, bias, and all that guesswork from the equation and replace it with hard, verifiable data. So, what does the day-to-day actually look like? Well, their job boils down to a relentless two-step engine. Step 1 is research. This is the exhaustive collection of data from vast and highly varied sources. Step 2 is analysis. That's the rigorous processing of all that data to formulate a definitive investment decision. Basically, whether to buy, hold, or sell an asset. Think about it like buying a new smartphone. When you're in the market for a new phone, you don't just grab the very first one you see on the shelf, right? No, you shortlist brands, you check out specs on battery life, camera quality, processing speed, and then you process that data against your personal budget to make an informed choice. An analyst executes this exact same process, but the stakes are exponentially higher. Instead of a $1,000 phone, they are evaluating corporate entities worth billions. They meticulously process immense volumes of data. We're talking supply chain logistics, complex debt structures, shifting market shares, all to form a high-conviction thesis that dictates major capital allocation. Moving right along to Section 2, types of research analysts and who exactly they are. We can basically break down this profession into 3 distinct buckets, and these are defined entirely by who employs them and who gets to read their reports. First up, the sell side. These folks work for investment banks or broking firms, and their research is actually out there in the public domain, complete with clear buy, hold, or sell recommendations and highly specific price targets. So when you see an analyst quoted on financial news networks upgrading a big tech stock, you are looking at a sell-side analyst interacting with the broader market. Second, we have the buy side. They work directly for asset managers like mutual funds or hedge funds. Their research is highly proprietary and strictly for internal consumption. The fund managers use these totally private insights to build the very portfolios that protect your retirement accounts. You're rarely, if ever, going to see these reports made public. And finally, the independent analysts. They work for boutique firms and sell their objective research on a subscription basis to institutions or individual investors. Because they don't execute trades or manage outside money themselves, their insights remain completely unconflicted. Next up, Section 3, economy, industry, company analysis, going from the macroeconomy down to the micro company. Okay, so how do they actually evaluate growth? Analysts use this highly methodical macro to micro funnel because, and this is absolutely crucial to remember, you simply cannot evaluate a company in a vacuum. A phenomenal business with amazing products will still struggle if the broader macroeconomic weather is stuck in a severe recession. So step 1 starts at the absolute widest point, the economy. As the famous British economist John Maynard Keynes established, governments directly alter economic performance through their taxation and spending policies. Because of this, analysts meticulously track macro factors like GDP growth, inflation trajectories, interest rates, and foreign direct investment. If interest rates are sky high, corporate borrowing gets expensive, which squeezes profit margins across the board. Once they understand that macro weather, step 2 narrows the focus down to the industry. What's the specific regulatory environment? How fierce is the competition? How sensitive is consumer behavior to price changes in this particular sector? And then finally, having mapped the whole environment, step 3 drills into the specific company itself, scrutinizing microfactors like daily operations, financial health, and the sheer capability of its management team. When they finally get down to the company level, analysts evaluate them on 2 parallel tracks, qualitative and quantitative. Let's use a cricket analogy here. Think of the legendary cricketers Rahul Dravid and Virendra Sehwag. Both were phenomenal batsmen, right? But they had completely different approaches. Dravid was highly defensive, disciplined, and calculated. Sehwag was incredibly aggressive and explosive. That represents the qualitative side, the intangible style. This is a lot like evaluating a company's management capability, its corporate governance, or the enduring strength of its brand power. Qualitative analysis is forward-looking. It tells you why a company succeeds and whether its leadership has the vision to survive future crises. On the flip side, you have their literal strike rates, batting averages, and total runs. That is quantitative, the hard statistics. This mirrors a company's actual revenues, profit margins, and factory capacity utilization. Quantitative data is backward-looking. It tells you exactly what happened and provides concrete proof of success. To truly predict future performance, an elite analyst has to master both, reading the cold, hard numbers and understanding the intangible human elements driving them. All right, Section 4, Rules of Engagement and Ethics, focusing on interaction principles. You know, when an analyst meets with corporate management, they're essentially stepping into a battlefield of perception. Management's job is often to sell the company, right? They want to highlight all the positives to keep those stock prices high. But the analyst's job, their job is to audit reality. Because of this dynamic, they operate under extremely strict rules of engagement. First off, they have to conduct exhaustive pre-meeting research on products and financials. A true professional never walks into a boardroom blind. Second, they must maintain absolute independence and neutrality. Their published opinions have to be anchored in verifiable facts, not slick corporate pitches. Third, to uncover the real story, they aggressively leverage their professional networks. They talk to suppliers, competitors, and distributors. Tapping into the supply chain often reveals the unvarnished truth about demand and inventory way faster than talking to a CEO ever could. And because time with these executives is so incredibly limited, analysts prepare highly specific, probing questionnaires. Ethically, they must disclose any conflicts of interest up front, like if they personally hold the stock they're covering. Finally, all their investment assumptions must be stated clearly in simple, jargon-free reports. The ultimate objective here is pure, unmanipulated truth. This brings us to our final section, Section 5, Essential Qualities of Analysts, or what we like to call the Analyst Toolkit. Executing this job at an elite level requires an incredibly rare, almost dual-brained skill set. On one hand, an analyst must possess a super high degree of comfort with numbers and financial data. This means true proficiency in Excel, mastery of advanced data analytical tools, and a deep clarity when deciphering complex financial statements to spot hidden trends or off-balance sheet risks. But here's the catch. Computational power alone is entirely insufficient. They also require a discerning mind with intense attention to detail. They need that gut intuition to know exactly where to dig when the numbers just don't quite add up. Plus, they need the human communication skills to ask highly pertinent, probing questions when they are interviewing management. Finally, they must have crisp, concise written and verbal communication skills to translate literally thousands of data points into a single compelling investment thesis. Finding someone who is brilliant at both hardcore financial modeling and aggressive human interviewing, that is extremely rare, which is exactly why top analysts are so highly valued by the market. So behind every moving stock ticker, behind every single shift in your retirement portfolio, there is a professional applying this exact framework. They are the ones synthesizing the macroeconomy, auditing the rosy pitches of corporate management, and running the hard numbers to determine the true value of an asset. Their rigorous pursuit of verifiable facts brings efficiency and order to the global markets, ensuring that capital flows to where it's absolutely most productive. Knowing the immense impact of these recommendations and the sheer analytical rigor required to make them, the real question remains, are you prepared to shoulder the responsibility of being the ultimate selector? Keep that immense power and responsibility in mind as you continue exploring the intricacies of the financial markets. Thanks for joining me for this explainer.